Big picture discussion with the Charles Schwab panel as stocks now are firmly positive on the day. Joining me, Randy Frederick and Collin Martin to assess the situation. Here in the middle of the week, Randy's managing director of trading and derivatives and Collin's director of fixed income strategies at Schwab Center for Financial Research. Afternoon, gentlemen. Hey, Collin, how come bonds didn't sell off today, even though our ISM Services still was printing pretty solid figures? What do you make of the response to the data this week?
I think it was just a pullback to some pretty significant moves we've seen over the past few days and few weeks. I mean, treasury yields of intermediate and long-term maturities have surged so much, and the data we saw today wasn't, I'd say, important or strong or weak enough to really move it in too much in one direction. I think it was just a little bit of a reprieve following such a sharp move. I mean, overnight we saw the 10-year treasury yield approach 4.9%. If we look at the actual data today, it was relatively mixed. If you look at that ADP report, that does suggest, and that could be a reason why yields fell a little bit, while there's not much of a correlation between the ADP and Friday's jobs report, it at least suggests maybe some loosening in the jobs market. In ISM, it was a little bit better than expected, but down from last month. I think what's important, if you look at that ISM, was new orders, which hit its lowest level in a while. But at the end of the day, I think neither of these reports were enough to really drive the market. I think it was just a pullback after what was admittedly a large surge.
Okay. So a little bit of a pullback in yields, $1.02, Randy, and markets find their legs here. Stocks, no, I think we described this as a pretty good day. Tesla's up 5%. Big tech, Alphabet, a little reprieve for bulls.
I'd say it was a pretty good day by the end, but I mean, it was a little shaky all throughout the day. The pre-market futures got a little bit of a boost from that ADP report, as Collin was talking about. But then we got a nice rally midday, then it all fizzled out again. We got a little bit of an uptick at the end of the day. That still kind of tells you there's an enormous amount of uncertainty out there about which direction things are going to go. I think the important report, of course, is going to be the non-farm payrolls when they come out on Friday. The ADP, as Collin said, isn't a great predictor of that, but it does have some correlation, and it kind of says that the ADP estimate right now, that the non-farm payroll estimate right now is probably a little bit too high. That's my perspective, and that's also based on the fact that we've had some pretty solid weekly jobless claims for the last several weeks. So I got a feeling we're going to see an upside surprise in payrolls, which will not bode well for the market on Friday.
Okay, that's really interesting because the market's thinking payrolls are going to drop from the previous reading, and obviously we're very sensitive to any better than expected data right now. The Fed speakers are pretty busy the next 2 days as well. Today was active. I mean, doesn't seem like the language is really moving the needle though, Collin, from the Fed right now. Is that just because we're all agreeing that we're not going to cut and we're not going to hike? Did we finally all agree on something?
I would argue that maybe it is moving the needle. I feel like if we look at comments from a number of officials, there's been a few that have been explicit about their, tendency and leaning towards additional hikes. And that coincides with the increase in at least intermediate and long-term yields. The interesting thing is that the Fed funds futures market and actual investors haven't really joined them in that view. And if we look at what's gone on over the past few weeks with the surge in treasury yields, we haven't seen much of an uptick in expectations for the peak Fed funds rate. In fact, if you look today, expectations for a hike in November are, I think, less than 30%. If you look at by December, it's still less than 50%. So even though there's a majority of officials who, at least by their dots, think that another hike is likely, and there's at least a few outspoken people who have talked about the need to hike, the markets just still aren't buying it. And that's what's interesting when you look at the shift in treasury yields. The peak Fed funds rate hasn't been revised higher. In fact, expectations have come down a little bit, and inflation expectations remain well anchored. So if you look at two key tenets there, that doesn't appear to be the main driver lately.
Okay. The wild cards are that there's some wild stuff going on in D.C. as well, Randy. Should we try and figure that out into our analysis as well, at least for maybe thinking about the potential for, VIX, where vol can go, or just the general uncertainty?
It's kind of hard to figure out what's going to happen when something happens that hasn't happened in well over 100 years. So I think it's a little bit difficult. But yes, if it does create anything, it creates simply uncertainty. And we have seen the VIX creep up above 20 both yesterday and today. That's the threshold where people start to get a little bit uncomfortable. It's not panic by any stretch. It's not even high anxiety, but it's definitely uncertainty. And that just basically means that, look, if I'm looking out as an investor a month from now or two, I'm not exactly sure where things are going to go. And my confidence in my ability to predict that has definitely gotten lower. So this is a big wild card. And I don't really think you can take it into account other than just simply to say that things may just be a little bit more volatile. And that's kind of what we saw for the first 5 months of this year when everyone was worried about that debt ceiling debate. If you look at what happened to volatility on June 1st, the exact day we got that debt ceiling issue signed, volatility dropped below 20, and it hasn't reached 20 again until just yesterday. So now we're back to those uncertainty levels that we saw in the first 5 months of this year.
Love that perspective, putting it into the VIX history here for us. Appreciate it. Good analysis about the economic data, too. Importantly, how some of our numbers are going to connect to NFP on Friday. Appreciate it, guys. Randy Frederick and Collin Martin. Thank you, gentlemen.